What's going on, guys? Welcome to Stock Talk episode number 2. We have a lot to talk about for you guys today. I'm Brandon. This is Cole. We have a lot going on in the stock market right now. We're going to go through interest rates, Tesla, Palantir, valuations of the stock market, what the Fed's doing with interest rates. A lot going on right now. What are you thinking out there, Cole? What's going on, man?
Yeah, I think we start off with the Fed rate cuts that happened this past Wednesday. Um, that is where we seen a big dip in the market, and I think it was more towards it was not that they cut 25 basis points; it was the expectations going into 2025 that they're not going to be cutting as many as we expected, and I think the market adapted to that or reacted to it. I would say and that's where we seen a big dip on that Wednesday afternoon. Um, so with that, the Fed cut 25 basis points, bringing the total for 2024 to 1% down to 4.25. And now they project. It kind of looked like they were projecting to go two more cuts in 2025 versus the four that I guess the market believed. And I was listening to Beth Hammock, the Fed chairman out of Cleveland, and she didn't think there should have been any cuts this time. So I don't know where we're headed from here. I don't know what 2025 is going to bring and what the interest rates may do, but I think it's definitely something that the market reacted to, and that's why we seen what we seen on Wednesday.
Yeah, I agree with you. I talk about all the time how interest rates are like gravity on the stock market. So we've talked about this. We talked about this on the previous episode to this one too, where it's like if if you assume the stock market does 10% per year, that's considered to be a risky return right there of 10% by most people. But if you want to go buy a bond and a bond is 1% versus 10% in the stock market, you're not going to mess with the bond. It's a complete waste of time. Um, so basically, the implication of less cuts for next year is basically saying instead of the bonds being 3%, they might be 3.5%. So I feel like that's why this was a dip that happened right here after the Fed. And then pretty much most of the dip got ate back up right here because the market is usually, when the market's been going straight up like it's been doing, I mean, it doesn't look like it there, but here the market's pretty much going straight up almost 30% this year. When the market goes up so much, it almost looks for a reason to try to do a sell off. And it's just like a capitulation and people taking profits. So the market kind of overblew, having four cuts versus two. Um, I don't feel like having, 3% to 3.5 is a big needle mover to the 10% in the stock market. I feel like valuations right now are a little bit lofty, but we're in the beginning, in my opinion, of a very big growth cycle where it's kind of like the industrial revolution, but for tech. Um, just imagine, like, at the rate of progression that we're doing right now for ChatGPT and like Tesla Autopilot and the Optimus robot and all these large language models, they're going to be so entwined in our lives in 10 years from right now. So it's kind of like the haves and the have-nots. So you either invest or you get left behind, in my opinion. So that I feel like is a bigger needle mover. I mean, rates are important. Obviously, that's one of the most important things, but we are close to the par rate right now. So let me zoom out on this chart right here. So this chart corresponds to what the interest rates were since 1955. So from the 50s all the way to the 80s, this was a Volcker area right here. This is where basically inflation was super high, but you could also go out there and get literally a 19% CD or a bond on your money right there. So if the stock market historically is going to do 10% a year, there's no reason on earth why you would want to go get why you wouldn't want to put your money in the stock market when you could get a 19% bond. There's no debate on that. Warren Buffett said many times he wishes when this was crazy high right here, he would have just went and bought like 30-year treasury bonds at 19% and just locked in 19% a year. And of course, like I would do that too. It's freaking crazy high. So like when you look historically speaking, yeah, we had this super tight, super high rate hiking cycle right here, but it's like historically it's not really any higher. I think it's below average and it's even going to continue to trend lower. So I think that there's a lot built into the market right now from a valuation standpoint and bringing earnings back to right now. Um, but I think it's close to justified. I think we're a little bit overvalued. Um, I talk about all the time, like maybe the market's 10% overvalued right now. And that doesn't mean it has to dip by 10% to be at par value. But, you could think of it on the bearish side where the market's 10% overvalued right now. So it's, inefficient. So what if it goes to 20 or 30% undervalued, which then implies a 30 to 40% drop? The market can do that, and people need to understand that the market's not always rational in the short term. So the key is like right here, this was an opportunity to buy right here. I get it that it's only a couple percent off of all time highs, but think of this dip right here as kind of like a rubber band and you're stretching it down. When you let it go and it wants to fling back up, that's what happens. Usually, the stock market, if it goes down really sharp, oftentimes, but not all the time, it'll rebound up just as fast. But keep in mind, some stocks go down and they deserve to stay down. We talked about BlackBerry last week, how Apple kind of wiped them out.
Right. Yeah. I mean, now the here's where we're at. What the housing interest rates though haven't seen much of a correlation with the Fed cuts. I feel like housing interest rates are staying the same, and usually when you're cutting rates, the Fed's loaning out money at a cheaper rate, and the banks and mortgage loan companies and stuff, they'll go ahead and forward that lower rate to the consumer, and I don't see a big difference in the housing market right now. So I'm kind of a little bit concerned what's going on. I think the rates are very important. Yes, they are low on average compared to the rest, but I think we need to see some movement in there, especially if a lot of people are waiting to buy houses and they're waiting for rates to cut, and then rates are cutting and the mortgage loan rates aren't cutting. So uh, I'm waiting to see when that will take effect.
So typically speaking, so the federal funds effective rate, the interest rates are typically 2% over what the federal funds rate is. It's typically a 2% spread. I mean, that's kind of like the profit that banks make. So banks could essentially borrow money from the Fed at 4.6%, and then they go lend it to you at 6.6%. Rates right now are pretty much like rate at 7 with no points. So there is a little bit of a premium built in, and I think there's opportunity for them to come down a little bit. But you know, I think people need to get more used to seeing rates in the 6% level unless we get some sort of recession or inflation just decides to go way down. I'm not expecting rates to fall. I mean, even I was wrong. I was wrong about this too. I expected rates to fall quicker than what they've been falling. Um, and they really just haven't been falling as much as we really expected. So the key is to get a good deal when you buy a house. I mean, like the rentals that I buy, you make the money on the purchase. You don't make your money on the rate. It's about getting a good deal and a good price at the time. It's not so much, hey, my rate's going to be 5% versus 6%, so I don't want to do the deal. If you could do the deal and make 100K on the house or whatever it is, I mean, that's where the money is to be made. So that's kind of how I think about it. I mean, there's a lot of gridlock out there. Like a lot of the one rental, I have a rate of 2.7%, and it's like, imagine that I still lived in that house. Like I would never want to move because the mortgage is so freaking cheap. It's like the mortgage is going to be double if I get the same house down the street, which is a new loan. And that's how most Americans feel right now. So it's kind of like, it's a good thing though. Like it's a silver lining that rates are kind of staying higher because let's look at history. If we look right here, actually, I'll just leave the chart fully open. So these gray lines right here are recessions. So right here, the rate was pretty much zero. So if we would have got a recession in June of 2013, what ammunition does the Fed have to try to save the economy? Yes, they can go print money and inject money into the system, which is quantitative easing, but from an interest rate perspective, they're already at zero. They can't cut any more than zero. I mean, I know, briefly in this period right here, rates in Germany and in Europe actually went negative, meaning you put $100 in the bank and you would get back less than what you put in. Makes absolutely no sense to me why people would do that, but people did it. And right now, it's kind of like we're at 4.6%. So if we happen to get a recession or something crazy happens, or there's a COVID 2025, whatever it may be, we have 4.64% of ammunition in the tank to cut to zero. But if we were already at zero, it's harder to get out of the mess. You know what I mean? We have ammunition. So I feel like the Fed's keeping that in their back pocket just in case. And I mean, I would honestly do the exact same thing as them. The labor market's strong. We have inflation, but inflation is a function of demand in the economy. So if there is less demand to go out there and buy this pen, for example, Staples is going to go lower the price on the pen. And that comes down to, just like I said, supply and demand in the economy. So I talk about all the time also where it's like, I would much rather have kind of high inflation, which I don't even think it's kind of high. It's 2.5% right now, and the target is 2, and we were at 9% 2 years ago. So slightly higher inflation with a strong economy with slightly higher interest rates is way more preferable than rates at 0%, but you have a recession.
Right.
So that's kind of like my thought process on that.
Yeah, it's definitely something people are waiting. Everybody's waiting to do the same thing. Everybody's waiting for to get that 2.5% interest rate again, or under 3% interest rate on a home. And I just don't see it coming anytime soon. Um, and I really don't know when we could see those kind of rates again. And but as long as they trend downwards a little bit, I think, like you said, people are still spending money. That leads us into the PCE data that came out on Friday, which was pretty good. It rose 0.1% to 2.4%, which was slightly below the 0.2% expectation. So people are still spending money. Whether interest rates are high, whether they're low. Um, that's always good because labor market's strong. People are spending money. That's good for the market. That's why we've seen a little bit of a rebound on Friday. And like you said, that's just an excuse or a reason for people to buy the dip or to rebuy, is when little something comes up. That's what they do to justify buying after they just sold off. So I think we've seen a little bit of crazy last week with the big dip after the rate cuts, and then the PCE data released, and it was just, I mean, very so slightly better than expectations. And we almost we're almost back to where we were at uh, from Wednesday till where we're at now. So those are good signs. And I think people are fine. I know it's Christmas time too, but people were spending money last month. They're going to be spending money this month, and I think the economy is in a good shape. So I think we can move on to Tesla again. What are we doing with Tesla? It's just been all over the place, and I know you have some plays on Tesla. So yeah, look at that little dip in buyback. So let's talk about Tesla. What do you think here? What are we seeing?
So Tesla's interesting, and I'm a fundamental guy. I'm not a big technical guy. So when you try to see what Tesla's going to do going forward, I think if you look at anything shorter than a 3 to 4 year time horizon, I think you're totally gambling buying into the stock. Um, the valuation level that we're trading at right now is pretty much pricing in perfection for the next 4 years. Um, the P ratio, it's actually a lot higher than 126. So if you're ever going to calculate P ratios, do the numbers yourself. The P ratio is closer to 200 right now. So what that means is if you were to buy the entire company of Tesla outright for 1.45 trillion dollars, I know nobody has that much money, but if you did have that much money, it would take you roughly 200 years at the current earnings to get your initial investment back. So that's not a good investment. That nobody would want to do that investment if you go buy any regular company in the real world right now. But the market right now is pretty much bringing earnings backwards from like 2027 to 2028. They're taking earnings and bringing them back to right now. So that's what's being priced in. But typically, what the market does is it'll only price in roughly 1 year out. And I feel like because Trump and Elon are best buds, there's rumors that Elon is trying to roll out unsupervised FSD in Austin in 2025, kind of in the first half is what I've been hearing. all speculation. But I mean, I have a Tesla, I have FSD, and it's really good and it's getting better every week. So it is totally possible. But it's like at the end of the day, how much is that going to truly add to the bottom line? And I've run the numbers before where even if they have millions of these cars driving on the road autonomously, and let's just say you pay $300 a month for the service to send your car to the network or whatever it may be, it's still not going to generate enough money to justify the valuation right now because the valuation is just so high. People, overlay Tesla charts on top of Nvidia charts and stuff like that, but the difference with Nvidia is Nvidia is actually growing its earnings and revenue by triple digits year over year. Tesla's earnings growth is only up roughly 30% year over year, and revenues, similar to that. So it's definitely lofty, but I believe that when 2030 or 2035 rolls around, transportation is going to look totally different. I think that most of the cars on the road are going to be autonomous cars because it's going to be cheaper and safer and more convenient. It's going to be more just easy to do. You're going to be able to pull out your phone and do work on the way that you're going to work. I mean, it's just more efficient use of your time because most Americans, I mean, they commute for 45 minutes a day. So that's 45 minutes of your day that you could check your emails or go on IG or whatever you want to do. Um, so you have that time back. And then on top of that, which I think is the really big needle mover that's not priced into the stock, is what the Optimus robot is going to do. And I feel like Optimus is probably not going to come until 2030. We might have some sort of hint of it coming with like a date maybe, but I don't think you could expect Optimus to be in your house until 2032 is my guess. I'll show you a picture of what Optimus looks like. This is a picture of the bot that they're making, and it's pretty sweet. I mean, the dexterity of the fingers and stuff like that, like it's pretty much operates like a human. But I feel like when this is mainstream, walking around the streets in your house, doing your dishes, doing whatever you needed to do, working in warehouses, delivering your packages, stuff like that, I feel like the price of Tesla stock is going to be much, much higher than what it's at right now. My 2030 price target is $1,200. So that's pretty much implying a 3x from right here. But I think it's going to be a very bumpy ride to 2030. I think that, I wouldn't be surprised if Tesla falls into the 200 level next year just on a correction basis because I don't think that robotaxi is going to roll out as fast and easy as people think. And I also just don't think it's going to produce as much profit as what people think too. Not saying I'm bearish on the stock by any means. I mean, I have a very large position in Tesla, but I plan to hold it until I have Optimus sitting next to me right here. So
Oh, he wants the robot sitting next to him on the couch before he sells.
yeah, that's
Me, on the other hand, I don't know. I think I've seen iRobot too many times to be all bought in. With that being said, yes, I still love Tesla stock. I personally am not buying at the price that it's at right now, but I will if I would love to wait for the dip to maybe get back in some more shares. I just think Tesla's such a great company, along with Nvidia. I think that's the future. Certain things in sectors come along and they just grow and continue to grow. And I think, in this tech market right now, we are very tech heavy, and I think it's going to continue to grow, get better. And as we move forward and we're going to advance, what we can do in a year would have taken them in the 20s, 60 years to do. So I think we could just continue to get better, and the advancements happen so fast that, yeah, once we see the first start of robots coming in 2030, 2031, somewhere in that range, it's like, okay, now they can almost, double that and triple that year over year. And that's where you could really see a boom in Tesla. Let's move on out of here. Let's look into Palantir. Man, Palantir, that is probably the hottest stock in the last 3 months. And I'm not sold on it yet. I wasn't sold on it before. I'm not sold on it. Definitely not sold on it now. I don't know. People are loving this thing, and it has the stock price has shown and we're up, yeah, just like this, 6 months, almost 250%. Um, and what have we learned in 6 months? I don't know what's there for people to have this much of a confidence in a stock that just doesn't show its earnings of a 250% gain in 6 months.
I totally agree with you. The P ratio is actually close how Google calculates it right here, which I never trust anybody's data. I do it myself, but this is actually kind of close. So, same example, if you have $187 billion to go buy Palantir outright, it'll take you 416 years for you to get your money back on current earnings. I get it that they're probably going to grow earnings going into the future, but I promise you that if the market takes a correction, meaning like the Nasdaq and the S&P 500, if the Nasdaq were to take a 20% dip, I would be willing to bet that Palantir is probably going to go down like at least 50%. The stocks with the high PE ratios that pretty much have perfection built into them, when the market goes red and the tide starts to turn towards the bearish side, you'll see that people get smoked out. And I feel like, it kind of went, I mean, this pretty much is meme-ish. Um, let's look at their earnings real quick. So they reported Q3 earnings in November. Their revenue year over year was a 30% increase. So read what the CEO said right here. This is a quote: AI demand that won't slow down. So just think about this in general terms of anything in business. If you have unlimited demand year over year, why is your revenue only going up by 30%? Like, if you have unlimited demand and your product is so much better and it's so good, why aren't you able to raise your prices? Like, if we look at Nvidia right here, look at Nvidia's report right here. So their revenue year over year is up 94% year over year. So Nvidia is up 94% and Palantir is only up 30% revenue growth year over year. So also keep in mind that Palantir is a much smaller company than Nvidia. So just the law of large numbers, it's so much harder to grow at 100% year over year when you're already a $3 trillion company versus Palantir, who is a $187 billion company. So it's orders of magnitude of a smaller company. Um, and they're not growing like they should, in my opinion. I really think the stock is ultra overvalued. I think if we were able to bring Warren Buffett on and say, what's your intrinsic value for Palantir right now? I feel like he would say it's somewhere around like $30 a share, in my opinion, somewhere in that area. Um, I feel like if you're buying in at these levels right here, yeah, you can make money and it could keep going up. But at this point, you're just pretty much betting that the next person is going to pay a higher price than you. The earnings don't justify it. Even if they double their earnings next year and the stock price were to stay flat at 82 bucks, the P ratio will go from 400 to 200. So that's still ultra, ultra lofty. So I'm definitely not going to touch it. So anybody that's listening to this that is in Palantir, consider, if I were you, not telling you what to do, but if I were you, I would definitely take profits and put your money elsewhere. Not saying you won't continue to make money in Palantir, but um, I think that the odds are stacked against you at this point right here.
Yeah, like you said, I think it's just I think you could call it an Nvidia effect. I think that everybody that missed out on Nvidia wants to find the next one,
Hmm.
and I think everybody's buying Palantir in hopes that it could be the next one, and it's just not showing the revenue and earnings that it should to be where it's at today. And yeah, definitely one in 2025 that I'm fading. I don't know enough of it. I don't see enough out of it to justify spending that much over where I feel it should be. And people are just buying it up, and it continues to go up. It's like I want to.
I mean, dude, look at their earnings per share is 6 cents. That's 6 cents in the last quarter. I mean, if we just it was less in the 3 quarters previous to this. So if we just do 6 cents, that's 12. So that's 24 cents. They're literally earning 24 cents of profit on an $82 share price. So if you just go and you divide it, so if we do 82 divided by 24, the P ratio, or sorry, yeah, the P ratio is roughly 400. So it's like it's super disconnected. I think that people are very interesting that want to buy into it right now, like you said. And this kind of like history almost repeats itself in a way. And the most recent, like, I'm not saying this is how it is right now, but in the 90s, like late 90s, anything or any company that put a .com behind its name, um, the stock price was absolutely mooning. And we've seen this recently, maybe like 4 or 5 years ago, we saw this when SpaceX started to go big time and more people were learning about it. There was these stocks that put like space behind it or galactic or whatever, something outer spacey behind the name. And the stocks were totally mooning. Just look up like Virgin Galactic stock and things like that years ago. They were mooning. So now anything that has like AI and how AI is so good and it's never going to slow down and blah, 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 there's just so much hype built into it. I mean, even Amazon did it where if you look at the pictures of Jeff Bezos in his original office with the original Amazon banner, the business was actually called Amazon.com, not Amazon, but then they changed it. And even though Amazon survived and made it, let's pull up Amazon stock just to show you real quick what it did in the 90s at the ultra high valuation level. Um, Oh, it won't even zoom in. I have to drag the chart. We could go into something else and I'll get the chart to come up. It's right here, but it's just so hard to tell. The stock basically went. I mean, you can see it on the numbers. It went down like 95% is what I'm getting at. It's just such a huge move right here that it scales it out. You can see it went from 4, then it's going to go into the cents right there. It went down a lot, and yeah, the company made it. So it's like, is this what Palantir is maybe going to do? Is Palantir 10 years down the road going to be great? But it might fall to $20 a share in the meantime. I mean, nobody really knows, but there's no margin of safety in Palantir right now. Everyone's a genius in a bull market because they're making money right now and everybody loves it. But the tide eventually will swing to what the valuation should be, in my opinion.
Yeah, I agree. I just, yeah, I think it's all FOMO buying, and I'm not interested.
That's crazy.
Um, what do we want to go to next?
You want to hit on
Yeah,
AMD super quick?
AMD, AMD. I think I like AMD a little bit more than you, so I think that's okay. But yeah, I think AMD. I like AMD. I don't know how else to say it. I do. I know you don't love it. I think
Why do you like AMD? What are your main reasons why you like it?
I just think that I think they have room to grow. I think they have room to grow, and they've done it. Um, they've continued to beat earnings and continue to grow, and I think they're a little bit more stable than Palantir, and have a history. Um, I just think they're one that all the analysts have a high target market on it, a target price on it. And again, I just think it's one of those that's a little undervalued as far as what I believe, even though the PE ratio may be a little high. It's somewhere in the hundreds, the PE ratio there, but it's a lot better than 400 on Palantir.
Yeah, I totally agree with you. I was just going through the most recent earnings report right here. Um, I mean, my arguments against you and then with you is their revenue growth year over year is 17%. So, or sorry, 18% year over year. My bad. So 5.8 billion, 6.8 billion, Q3 23, Q3 24. So it's like, again, if you have unlimited demand, why are you only able to increase your revenue by 18% year over year? I don't understand that. And I'm going to always revert back to NVIDIA is you want to find a company that has a durable competitive advantage. Like what advantage does AMD have over Nvidia? Are their chips better? No. Do people want their chips as much? No. Like when Tesla just built or when XAI just built Colossus, their supercomputer for Grok, and the training cluster that trains FSD, Elon is buying the Nvidia chips. He's not buying AMD chips. So it's like it's never I just feel like they're always going to be a day late and a dollar short. And that shows right here that their revenue is up 18% year over year. And Nvidia at a much larger market cap is up pretty much triple digits. I mean, you could look at earnings and say, oh, yeah, the earnings are up 161%. But this was probably some sort of efficiency that they found within the business, or maybe they sold something within the business And when you sell a certain part of the business, I don't know, I'm just speculating right now. But if you sell a certain part of your business, that'll show up on your balance sheet as cash, and or that could look as income also, and that could temporarily boost earnings per share. So it's impossible to grow. I mean, it's pretty much going to be impossible in the long run to grow your earnings per share of triple digits like 160% when your revenue is only up 18% year over year. You're eventually going to come to a bottleneck where it's like this company is running at max peak efficiency. We cannot squeeze any more profits out of it unless we start growing our top line, which is revenue. So that's kind of how I feel about that. I mean, I'm not saying I'm bearish on the stock. And also, one thing that people need to keep in mind: GAAP is generally accepted accounting principles. Non-GAAP is not that. Basically, what GAAP versus non-GAAP is Warren Buffett and Charlie Munger said non-GAAP was pretty much like garbage earnings. So non-GAAP, you could basically say whatever you want, and a company will say something along the lines of, "Oh, well, we had to spend X amount of money on capital expenditures because we build a new building to manufacture a chip or something," but it's a one-time charge. But it is a true charge to the business, so it should be included as money that they spent. So if we look right here, if we look at Q3 2024 operating expenses, they spent $2.7 billion for GAAP, but non-GAAP operating expenses, it's $1.9 billion. So this is a huge spread of earnings. So huge spread of expenses. These expenses right here actually happened. These expenses right here did not actually happen. So, or they're just excluding the ones that actually did. So it's always going to fluff the numbers. And then when people say, oh, AMD beat earnings. So if we go right here and it says AMD was expected to go 92 cents per share, or sorry, that was the previous one. Was that? Yeah, AMD was expected to report 92, and then they did report 92. So when we go back to here, yeah, they reported 92 cents, but that is non-GAAP earnings. If you're doing it on GAAP earnings, they missed by a massive margin. They missed by almost 50%. So you got to understand what you're looking at and GAAP versus non-GAAP, because this is a very wide spread of GAAP versus non-GAAP. If you look at really, a lot of other companies, like we could talk about something else while I look this up. But if we do Apple, for example, their GAAP versus non-GAAP earnings, it'll be way, way wider. Sorry, I spelled that way wrong. So what do you think about that, Cole? I'll pull this up while you comment on that.
Yeah, I mean, like you said, they could only cut so much costs, and if they're running at peak performance, they need to grow their revenue. I think that's where I'm at. I think their revenue can grow and will grow. So that's the difference here. I like what they've done in the past. I like where they're at, where their earnings and where their revenue are at. And again, if you're making, $100 and then you make $200, it's 100%, revenue increase. And, if they're doing it at the $1 billion level, they're still 18%, still 17 or 18%,
I don't know
increasing
if
year
Apple
over
does
year.
non-GAAP earnings. I think all of Apple is GAAP. I couldn't find it. Maybe the more established companies, they only report GAAP. I know a bunch of companies report non-GAAP, and people just get so sucked into it. I'm looking on NVIDIA right here. I don't see
It's right.
non-GAAP. Do you see non-GAAP?
Yeah, right there. Yeah.
Oh yeah, right here. Sorry, my bad. So look at the spread of NVIDIA GAAP versus non-GAAP. It's 78 cents versus 81. See how that spread is so tight right there?
Right.
So basically, it's not like it's accounting fraud for what AMD is doing. They're basically just saying, hey, we had a crap ton of expenses, but they're one-time expenses, so we don't want to include that. So we're just going to say our earnings, we're just going to throw that out and say we made 92 cents per share. So I think people are getting attracted to this dip that AMD made where it peaked out at 210-ish and now it's 126. This is what happens with companies that once you really dive into the fundamentals, they don't have a durable competitive advantage like you might think. So I won't touch AMD because there's other things that you could touch that are way better. I mean, I can't really think of one reason why I would rather own AMD than Nvidia. Honestly, Nvidia is cheaper on a valuation standpoint. They're more established, more durable competitive advantage. Everybody wants their product. Their product is the best. So just because this fell from 207 to 126, like, yeah, it's a 50% drop. But keep in mind, like, this drop that it happened right here, this could be like a Palantir type drop where it's just going down and it just keeps going down because people like it's not worth it. It's not worth its weight in earnings. So if they raise their earnings, yeah, it could go back up. But people will see that if you only grow top line at 15%, it's hard to grow earnings, a lot more than that in the long run.
Right. Yeah. And like, to touch on it, the gap versus non-gap, I would put gap as, correct me if I'm wrong here. The difference in, like, you own a home and you have your same water bill every month, you have the same bills every month, and those are your normal bills. But oh, hey, you know what? This year I had to install a new roof, but we're not going to count that because you only install a new roof every 30 years.
That's
So
exactly what it is. They're just saying but you still have to spend that money.
right, but it's not normal because you only put a new roof on every 20 or 30 years, or whatever it might be. In that aspect, all your normal bills are the same: your gas, your water, your electric, your internet, and that's your month to month basis. And then when you go ahead and you have to put a new roof on, you're like, oh, yeah, that's a huge expense, but it only happens once a year, so we don't have to count it.
So this is another thing too. So it's like you really got to understand the minutia of valuing a company. And another thing that's kind of similar, like there is value in looking at gap versus non-gap because those things truly probably are one-time expenses, but there's always going to be one-time expenses and they really are expenses. But if there's like a really huge hit, like I remember with Google when they got like antitrust things years ago and they had to pay big fines and stuff like that, and Meta, Facebook, they had to pay huge fines. Like that is truly a one-time charge. That's probably not going to be a recurring thing. So it's good to look at both ways to understand, like, okay, how is the underlying business actually doing? And another thing I like to look at is people, all they say is, oh, it beat on the top and the bottom line or whatever it is. But people are going to say, so net income right here is essentially the profit of the company. And then diluted earnings per share, this is the earnings per share profit. This is GAAP. So people are going to say, well, how is the profit and the earnings per share not growing at the same percentage rate here? And the reason why typically earnings per share is higher than what the net income of the company is. So just profit of the company, and then you divide it into the shares, and that's how much the profit is. The reason why earnings per share is usually higher is because companies buy back their stock. So usually that's how you know if a company buys back a bunch of stock. And we could dive into Apple if you want because they buy back a crap ton of their stock. So even if a company has a net income of 0% year over year, like it's flat growth year over year, they could still have earnings per share growth because they're buying back their stock. So that's kind of like diving in a little bit more, like looking at non-GAAP versus GAAP. Don't just look at earnings per share, look at earnings in total, and then look at earnings per share. Because if you have flat earnings year over year, that's 0%. But then if you go buy back 10% of your stock, you're going to have flat earnings growth, but your earnings per share is going to go up by 10% because there's 10% less stocks out there outstanding. So there's a lot of things that go into valuing a stock. It's not so simple as saying revenue is up, earnings are up, it looks good. Like you gotta really dive through the fundamentals deeply to feel confident to buy a stock. That's why I tell most people just buy into the S&P 500 and triple Q and call it good, because people aren't going to put in the time to truly understand this stuff.
Yeah, I don't really have much more to talk about.
Yeah, I think this.
For
Sorry.
this for this episode, I think it's getting ready to end of the year here. I think maybe we make one more on a end of the year basis. But I think it's been a crazy week, a good week. Let's head into Christmas and see where we go from there.
Yeah, Merry Christmas, everybody. We'll do these, like we said, roughly every week. We'll do a episode. If you made it this far, that's awesome. We're gonna get more streamlined with this process, and we're gonna have better things to go through and things to talk about. We're trying to figure out our system here of what we want to talk about, and comment below, what you like about this and what you don't like, and we'll work on it. But I'm Brandon. This is cool. We'll see you guys in a week.
Hey,
Later.
we'll see you.